Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. For those of you that are new with us, we go through each and every week this disclaimer. So take a moment to read through it or take a screenshot of it. I'll give you the two main highlights, which is to understand that we are not registered as individual investment advisors in the United States, and any pricing that we talk about is considered to be denoted in US dollars unless we note otherwise. So those are the two primary things. And just to give you a bit of a rundown, again, for those of you that are new, we'll start off, I'll do a little brief, there is something interesting that's occurred with the market to talk about. So we'll do a little brief analysis of where we are currently in the market. We'll go back and look at some of our previous case studies on our website, if we've closed anything, which we've closed two since last week. And then we'll review some of the past TradeFinder case study considerations that we've identified in the past several weeks, and then we'll look for new ones. And with the time allotted after that, we'll take some questions. So go ahead and ask your questions. The support staff will answer them if they're able to. If it's a question that needs to be specifically directed to me, they'll do that, but we'll get those at the end. So I just wanted to make sure that if you had a question, go ahead and ask it, but please understand that I get distracted. That's what happens as you get older, and so the questions will be held to the end. All right, with that said, let's get going. So we'll take a look at where the market currently is. Here's the chart of the S&P. And the thing that I wanted to point out, which is the interesting thing, is the fact that we did finally close this gap that created what's known as an island reversal. So when you have a gap up, and then you have a few bars, and then you have a gap back down, or vice versa, it can be the gap in the opposite direction. It's known as an island reversal because these bars are just kind of floating out on their own. And sometimes, obviously not all the time, because it didn't occur in this instance, you get a reversal for a period of time. It doesn't have to be a drastic or volatile move, but you get a move in the opposite direction. We did for a couple days, and that was it. Basically just enough to form the island reversal, and then we've gone sideways since. But that gap got closed. It hadn't been closed until yesterday, but yesterday's high in the market did actually close that gap, which means that a significant move down is out of the question from the island reversal as well. So we've had the zigzag become disqualified to the downside. Now the island reversal pattern to the downside, kind of getting the idea the market just doesn't want to go lower, at least not yet. But we're starting to get towards the outside of the Elliott time window here for a move up to new highs, but we still have this zigzag pattern that's also in place, which gives us almost the exact same target as the wave 5 there. So we've got two different Elliott wave patterns telling us that we're likely to go up and make new highs, if not significantly, just barely. But that might be enough, because you make a new high and then the media is all over it, and then whatever money's on the sideline comes jumping in, and that may be the move that the shorts are finally waiting for to step in and push things back down. But for now, it looks like kind of a drift to the upside, if you will. But it's not unusual to think that we're having a little bit of problem at these recent highs either. In other words, problem I mean by resistance, that the market is coming up here and finding a little resistance at that area. If we look at volume, you can see that volume has been decent, at least average, on the past couple of days. So for a while there, the volume was waning, and that was something that you wanted to pay attention to as far as a potential break either to the upside or the downside, but basically just corresponds with the fact that we've been going sideways. So it makes sense from that aspect. So the question will be, when do we break above this high? And then once we do, it would seem like there's really nothing from a technical standpoint to stop it from going up to test the recent highs and, according to our Elliott wave patterns, break them at least for a small amount. So looks like we're wanting to drift back to the upside. We have our downside protection on for our subscribers, but we have an awful lot of upside trades. And speaking of that, let's take a look at a couple that we closed out on the website. And again, if you have questions about the market, go ahead and ask them. We'll cover them at the end. But that's really about. Well, let me show you one other thing. On the DMI, the ADX is just kind of uninterested. And that's not unusual with the fact that we've gone pretty much sideways, except for closing the island reversal gap. But there has been a bit of a move from this support area here. And so far, the ADX is really not interested in it. If we break above here and we break the new highs and the ADX doesn't curl up, well, that would be a significant warning that don't get sucked into the markets at new highs, et cetera, et cetera. Probably the shorts are getting ready to step in. So taking a look at our website, we did actually a couple that we've looked at here in the TradeFinder that we did end up sending out to our subscribers. And the first one that I wanted to show you is Trade 228, which is on LOGI. That was 2 weeks ago that we looked at this one in TradeFinder, and you can see we actually sent the alert out. Go ahead and bring this up on July 7th. This was the alert that went out to our subscribers. And here's the chart pattern. You're familiar with it. If you were with us, you looked at it. So I'm curious if you followed along with it or not, but we did actually send that out as a full alert. You can see that we were showing at this point in time signs of accumulation. Now that's going to be a key concept with what happened with the exit that occurred just a few days later. Accumulation and distribution are two very important things to watch for, and that's why you look at volume pretty significantly. Price to action with volume, price to volume are always going to be important no matter what indicator you're looking at. As you know, we focus an awful lot on Elliott Wave because we feel like that is the best forward leading indicator that exists from a technical standpoint. But you always want to pay attention to price to volume action. And here we were seeing some signs of accumulation as the stock was moving to the upside. That had been going on for a while, but what happened when we exited the position yesterday was we were starting to see the opposite of that. And I watched the 3-minute chart on the market, and that's for the S&P, for individual stocks. So when I'm watching the market throughout the day, it's the 3-minute chart. And what we're starting to see was that every time LOGI would tick to the upside, there'd be a big volume bar that came in, at least on the 3-minute chart, on the sell side. So it would be trying to move up, and then boom, there's a big bar that comes in and moves down. It recovers and goes back up, and then boom, it's sold into again. And that was going on for about half the day yesterday, which that's a sign of distribution. That's the opposite of accumulation. So does that mean that the stock is done going to the upside? Remember that at some point we're going to start the wave 4 here. We don't know for sure that that means that the wave 4 is starting, but what we do know, what that does signal is some player that's been in this, a player of significant size that's been in Logitech is starting to take profits. So they're using every upward bar to sell out and close and exit the position. So it was time for us to go ahead and close it out. So we sent the alert out yesterday to close the position out at 380. I know that some people got filled at 390 as well. The price right now of Logitech, here's the current chart. So you can see that we went down, tried to rebound a little bit, but even traded lower today. The price right now is 265. So basically you ended up losing the majority of the profit that was made in the position if you didn't exit at the same time that we did, because the entry was 250. So a good part of it is gone. So let's just use the 380 as an example. So that's $1.30 per contract. And the way we set up our alerts for our subscribers is no more than $500 at risk per position, but people have their own account sizes and they can choose to put as many contracts on as they want if they follow along with the alerts. But just if you just did one contract, think of that. That pays for a subscription to both of our portfolios for an entire month. Just that one little piece of when to get out. And I think that's the most important thing about having an alert service that a lot of people don't do, is they send you signals on when to get out, when to get in, but when do you get out? That's extremely important. So having this, sending out the alert, hey, we're seeing signs of distribution, you want to go ahead and close this position out, basically would have saved you the majority of the profits. So we returned over 52% in just 6 days in the position. But if you're still in the position now or yesterday, the vast majority of that profit is completely gone. So, you know, $1.30 in half a day or a day versus an entire month subscription. Think of all the other things that could have occurred during that time frame. And here's another one. We actually did Clorox too for our subscribers. We talked about this one last week. Remember, I picked this one last week. They said, oh, we're going to do that. We don't do a lot with fundamentals, but based on this second wave of the virus, this one has fundamental backing, and it can never be a bad thing to have a good technical pattern backed by good fundamentals. That just can never be bad. So we sent that out on the 8th, and look what it says, 0 days in the trade. So 34% in 0 days. The reason it says 0 days is because the exit alert was sent out less than 24 hours from when the entry alert was sent out. So it was a 1-day trade, entered on the 8th, exited on the 9th. And this goes into one of the guidelines. We talk a lot on Elliott Wave, and we're going to in our new Elliott Wave class that's coming out soon about rules versus guidelines. Rules are fast adhered to. Guidelines are general things that you follow, but if you drift from them at a point in time, it's understandable. A guideline is that if you can make more than 30% in 1 day, generally just going to go ahead and take that. That's just a general guideline that I've always followed. So we went ahead and sent the exit out. You probably know this chart from last week because we looked at it. So here was the exit that we sent to close it out. We had this big, huge gap, or a big move, the big bar, I was trying to say, this big bar to the upside. That created a little separation with the 10-day moving average. So that's showing you that, hey, we're a little bit overbought short term. Two things here. One, we're overbought, so we're likely either to pull back or go sideways. One of those two is going to occur. And then the second thing is when you see this spike like that, you get an IV rush. A lot of times people talk about IV crushes because that's when you're trading options, you get an IV crush, you're like, what's going on? You could have a stock move in your direction, but if they suck all the implied volatility out of it, the value of the option could go down. You could actually have a stock moving up and the value of the call option, a long call, go down if they pull all the volatility out. So when you get a big day, especially in a stock like Clorox, which, yeah, we had some big days back here when this whole pandemic thing first came out. But in general terms, Clorox is not a volatile stock. It doesn't move a whole lot. So when you get several points, and it was up $4 there, it was up $2 a day before. So after we had entered it, it was up a little over $5 from the time we sent the entry to the exit. So that's a big spike for Clorox. So let's go ahead and take that profit and go. And so now let's take a look at where Clorox is right now, and look what happened. Exactly what it said. We were a bit overbought, and what have we done? We have come back and recovered that overbought scenario. The stock yesterday traded to the downside, down $4 yesterday as it came back to the 10-day moving average. So had we stayed in, then we would have, again, given the profit back. Now bounced back up today, so we're pretty close to where we exited the trade, but you were in a trade less than 24 hours and you made 34%. That's not a bad thing. So I thought I would go ahead and take a moment right now to show you, while we're talking about results, is show you the return that we've made since we started, or since the whole pandemic started. So let's take a look at what's happened. And you can see the date up at the top, February 24th through the 13th of July. So this is updated up till yesterday. So this is what's happened since all broke loose in the market. So we've had 23 trades that were adjustments, 26 that were new. So we've had 49 alerts that have gone out. Some people say, well, that's not super active. Well, We haven't been super active, in all honesty, but we've been very careful to pick and choose our spots. So on the way down, we sent 3 alerts on that big move down. On the bounce that occurred back to the upside, we sent 3 alerts. 5 of those 6 alerts were profitable positions. So out of the 6 alerts we sent between the way down and the bounce up, 5 are profitable. So, 5 to 1, that's a pretty darn good ratio. It wasn't a whole heck of a lot of trades going on in that time frame, but you still made money, and a lot of people lost money on the way down, and a whole bunch of people lost money on the way back up that were short the market and got just completely wiped out. So the open positions that we still have are 17. So that means that we've closed 32 of those positions. So of the 49, 32 have been closed, and 12 of the adjustment trades were winners. 13 of the new trades were winners. So 25 out of the 32 trades have been winners. And of the adjustments, that's 75%. Look at the new trades. 81% of the new trades have been winners. So an average of 78%. I think that's pretty darn good in this time frame, when I know there's a lot of investment firms that have been around for a long, long time are out of business now. They're gone. And we had a 78% winning percentage rate, and the average time is basically 3 weeks. So on average, we're 3 weeks in the trade. So the total profit that you have made, if you were following all of the alerts that we've sent out since the beginning of the move down on February 24th, is $2,829. And remember, as I mentioned earlier, we only risk $500 max per position. If you analyze that return out, that's just under 390% annualized return. If this same were to continue throughout the rest of the year and around to February again next year, well, 390% annualized. These are real trade. Everything's posted on the website. You just saw an example of the website. So if you're following along with some of the case studies that we've been talking about, and maybe you're following along the Logitech, maybe you didn't get out when we did, and now you've given up that $130. That was an entire month's subscription. How many of these trades do you think you would have gotten in addition to that during that month? So make money while you're learning. Just learn while you earn. Nothing wrong with that. It's a smart thing to do. All right, so there was Clorox. It's kind of back where it was, but again, less than 24 hours made 34%. We're going to take that every time. So I wanted to show you a couple of the ones that we've been. Remember, since we started TradeFinder, the one problem child we've had, I've brought this up a lot because it sticks in my craw, because we've had such a good success rate with the case studies that we've looked at. You just saw the last 2 weeks, is this one. And Henry Scheinman, we talked about this last week, about how it had kind of formed into this triangle and it may be breaking out. So the one trade that had looked like it was probably going to be a loser, it's not over yet. So it's breaking back to the upside. So stay tuned. I'll keep an eye on that one. Just for, giggles, just to see, because I think if you've watched these TradeFinders, the proof is in the pudding. We're right here. We're showing them to you live every single week. We're not Monday morning quarterbacking here. You know what we're looking at. We're keeping a record of it. We're being accountable. We're doing everything the right way. This is not, if you're looking for a get rich fly by night scheme, this is not where you want to be. Go play with some Robin Hood day trader somewhere. But that's not what we do. The other one that I wanted to show you is Apple, because it commented on this, that we talked about this, if you remember, back in here when Apple was around 340, and said with it moving this far, it's hard to imagine that it wouldn't go up and hit 400, because it's just one of those round number things. It's just one of those things that happens, that stocks are just drawn like a magnet to those round numbers. Look what happened. It got up. Okay, now in fairness, it didn't hit 400. It hit 399.82, but pretty darn close to 400. And then it bounced down. You can see the stock finished down on the day after running all the way up there. So some people use that as a signal to sell. Is Apple done yet? Well, according to the Elliott Wave pattern, at some time, we're going to have a wave 4 corrective move, but there's still new highs to come. That's what the Elliott Wave pattern says. If we look at the DMI, it's telling us we're overbought. We're currently overbought. Yes, the move is strong, but it's overbought. Remember, stocks can stay overbought, oversold for periods of time. Just when a stock gets overbought doesn't necessarily mean it's ready to go in the opposite direction. What I look at for that signal, which you've seen numerous times, and you've probably heard me say it till where you're sick of hearing me, but I'm not going to stop saying it because it's one of the most truest rules you can have in the world of trading. Is that a word, truest? One of the most true, whatever the proper way of saying that English-wise is, no security in any time frame gets very far away from its 10-day moving average. They just don't. Well, look what Apple's done. So the DMI and the ADX are telling us we're overbought, but not significantly from the 10-day moving average, so it continues to creep up, even though the ADX is showing us it's been overbought since early June, mid-June maybe. That's around the 10th of June, somewhere in that time frame. So for the month, for the past month at least, Apple's been overbought according to the DMI, but it's still trucking up and it's still hugging its 10-day moving average, which means it may not be done. We'll see how it handles this major move here at 400. But if the market does break above these wave 3 highs, and then we'd go up and test the recent highs and are able to break them, it's just really hard to imagine Apple not going up and hitting that wave 5 target, moving above there. So it's just somebody used that as a point to sell. Let's take a look at the volume, and you can see there was some above average volume yesterday. So it wasn't a massive amount of selling, just enough to push it back down. The market reversed during the day yesterday as well. So both of those things coincided to push it back down, but it traded back up today. It's back up to 388. It's likely going to go test 400 a time or two, and we'll just see if it's able to push through that. So that gives you a update of where we've been, some of our previous case studies, and then we'll go ahead and take a look at what you want to see now, and then we'll grab some questions. So remember, with the software, if you're a subscriber, you get this pre-computed scans where the search parameters that I look at to send out our alerts to identify them are here for you under Elliott Wave Options. They're pre-computed. So all of the indicators that I look at, if you did the trade scan series with us, you've got a good understanding of those. All of those indicators that are put together are in the search. So we have 2. That's interesting, isn't it? I mean, let's go back and look at the market again, and then we'll come back over here. It's not like the market has been bad. You know, we had this little support area. We talked about that. We've talked about how important 300 was. So we're above that. We've drifted above that. We're above the 10-day moving average, the 10, 30, and 50-day moving average. All those are moving to the upside. But we did look at that DMI that showed us that, yeah, you know, we've moved higher since the end of June. The 29th of June is the last time we tested that 300 level, and we've moved up since then. But the ADX is just not really too impressed with the move. I think that's the reason why out of all that, there's only 2. And I know, look, there's 350 again, consolidating stocks. That's our volatility portfolio where you utilize the math involved in creating a unique strangle where you're out of the money on the call, you're out of the money on the put. We set it up to where if the stock breaks, it has to break out. But if the stock breaks out, we're mathematically guaranteed based on the math utilized to create options, the mathematical formula, to make money as fast as possible. Again, that doesn't guarantee we're going to make money. It guarantees if the stock breaks out, the trade will make money as fast as mathematically possible. That's what it guarantees. But every week I've asked you, do you want to look at the consolidating ones or do you want to look at the directional ones? And you always say directional. So I'm not even going to ask you. We'll just look at them. Now, Charles River Labs, we had that one last week, didn't we? So that one's there too. But let's look at these 2. So we'll look at Masco. And when you click on it, you just click on the graph there on the results, and it brings it up and it shows you the results of all of the different indicators that we've talked about. So I'll take all those off. And then at this point in time, once we've got a result, what to do is turn the Elliott Wave on. So we turn Elliott Wave on, and then we look to see where we are from the current pattern. At this point in time, you can see that we are breaking above that recent wave 5, so that looks pretty interesting. Let's bring the DMI back on. Obviously, the ADX is moving up. It's between the two directional indicators, and it's above 20, but more above 15 is in the search because I want to be able to catch the ADX when it breaks above 20, not later. So it's moving to the upside there. So that looks good. I would prefer to see, especially with this break above that recent wave 5 high, a little more. The ADX is moving up, so that's really good. But we'd like to see this positive directional indicator. You can see we had an update today, have moved upwards. The negative is moving down, so that's good. So we're losing selling pressure. It would have been much better if we'd had a move to the upside on the positive, but it's still between the two, technically, just barely. But it does follow within the guidelines, and sometimes they're a little slower to react. So maybe in a day or two, that positive directional indicator does turn back to the upside. But we're trading here at $51, and the Elliott Wave 5 pattern is giving us roughly what, 57, so somewhere between 55 and 57 is the likely move to the upside. Then I always like to look to see if there's a zigzag pattern included in there. There might be one right here. Might not be enough of a, yeah, it is 38.2% corrective level. So the move expected then is to 61.8. That's what happened. Then what did it do? Came back down and tested the previous fib level. So what does that mean? If you've been watching these, hopefully you're starting to learn the rules, because that's what's important with Elliott Wave, is learning and understanding the rules. If you're going to make an extended C wave, you're supposed to test the previous fib level. It doesn't always do it, but we know not everything, nothing, I should say, is 100%. Nothing's 100%. So it normally happens. In this case, it did. So it came down, it tested it, moved to the upside, came back down, tested it again, and then we went to 100%. So that means that that C there is an extended C wave, because it made it all the way to the 100% level. Now we're testing that again. We broke down and we're testing it again. It doesn't have to come back down to 61.8 to move to the next fib level. It's already proven that it's an extended pattern. So that one actually looks pretty interesting as far as a continued move. Pretty decent volume today, so that's good. So maybe we will get the positive directional indicator to come through. Let's see what the options look like on this one. October has some liquidity. August doesn't have much at all. So July, the front month, has some, not much in August, and we skip to October, and October has a lot. It's pretty odd. But there's a decent amount of open interest in the October timeframe, more than there is in July or August. And the spreads aren't that wide. So that doesn't look too bad as far as putting a trade on. And look where the wave 5 pattern is here. So the wave 5 happens to be right where the next extended level would be from a Fibonacci standpoint. So you have Elliott Wave, Fibonacci. Remember, the zigzag is an Elliott Wave pattern. Elliott was a big believer in Fibonacci ratios. So we look at the zigzag as an Elliott Wave pattern, but we use the Fibonacci ratios to give us points of support and resistance, and therefore price targets. So the next level, if it continues to extend, would be 138.2%. And that happens to be right smack in the middle of the tap box time and price projection for Elliott Wave. So that one makes sense. All right, so we'll go back and look at Charles River again. Let's see where it was last week. I remember look at the CCI here. That's pretty interesting. And it's got a lot of it had a peak back here when it jumped to the upside. So it's starting to Certainly not overbought by any way, shape, or form, but showing some interest. The oscillator's moving up. This looks better than it did last week, actually, but it may have gone up. So last week was the 7th. Where's July 7th? Here is what we were looking at last week. So 181. Yeah, it's up $6 from last week. So it did move to the upside, even though we didn't choose that one. I don't really remember the reason why I didn't pick it. I just remember we looked at it. Maybe somebody, was it options? Or we just liked Clorox better. Well, it may have been the options because it's more thinly traded and the spreads are a bit wider. Yeah, that's the problem. The problem with this one is there's nothing between August and November. So there's no September, there's no October options. We just jumped to November. And it's not much in the way of open interest out there. It's not a whole lot in August. So next month doesn't have a whole lot either. There's 1,000 contracts on the 195 August strike. Spread's not super wide, but then the other ones are it's still kind of wide. That's the problem with this one. So we looked at it. Nice move today, but yeah, it's just it's troubling to. You're going to be trading against the market makers, which is never a good thing, meaning that if there's not a lot of open interest, then the market makers have to fill you. But they only have to fill you at the bid and ask. That's how the rules work, which means that they have to fill you at the ask when you're buying. They have to fill you at the bid when you're selling. Hopefully you can negotiate it and get filled somewhere in between. It becomes a cat and mouse game when it's very low volume like this. When the open interest is low, what you end up doing is you'll put an order in the midpoint, and if the open interest is low, they're not going to take it. So then you pull the order away. Just cancel it. Don't move it, cancel it, and then wait a while, and then put it in at maybe a few more cents. If you start, remember, this is only when you have low open interest that I'm talking about. If you start at the midpoint between the bid and the ask, and they don't take it, and then you just start inching up, they know you want it bad. So they're just going to sit there and wait until you get almost to the ask, or maybe all the way to the ask before they fill you. But if you show that, hey, if you're not going to give me a reasonable fill, I won't take this order, because they want to get paid. They make money by executing trades. They're not going to hold the position against you. They'll hedge it off immediately. But they're going to try to hedge it off at a gain if they can, or the least amount of risk that they could possibly have. Usually they get it to break even and they're happy. They just want the spread. So put the order in, pull it, wait a while, then put it in again at a slightly higher price. If they don't do it, then pull it again. You might have to wait till an hour or so, or even the next day, before you try it again. And of course the stock could run away from you in that time frame. But that's how you avoid having the spread, even on the August 195 that has 1,000 contracts, is $2.10 wide, and it's a 40 delta. So the stock would have to move a lot just for you to recover the spread if you had to buy at the ask and sell back at the bid when you were closing it out. So you need a pretty decent movement just to recover the spread between the bid and the ask, in between. So that's just a little game that you can play with the market makers. If you just start and didn't move it up, they're going to sit there and wait. But if you pull it and show them that, hey, if you don't give me a reasonable price, I'm out, at that point in time, you have a reasonable chance of getting fill. All right, so we really only have two that are potentials. So this one doesn't look bad. So let's go ahead and make a note. For this week, we're going to do MAS. And we'll see if that one works as well as Logitech and Clorox have over the past couple of weeks. So that'll be our official one. All right, we got a few minutes left, so go ahead and take some questions. That's everything that I wanted to share with you. Question, can I review QQQ? Sure. We quite often look at the S&P 500 as a benchmark of the market, but you can look at the Qs. So you take a look at, there's the chart of the S&P, and there's the back to the triple Qs, and then quadruple Qs, and now we're back to the triple Qs again. And obviously, if you've been anywhere around a financial network, you know that the NASDAQ has been outperforming the S&P and the Dow. So it's already at new highs and has been. And you can see the testing process that went on here. And this is what we're talking about, support and resistance within Elliott Wave with the Fibonacci ratio. So we came up, bumped our head, it broke above it, came back, look at it, tested it 3 straight days, traded right through it 3 days in a row, broke up again, came back, touched it on the low on the 29th of June, and then we've moved to the upside. So those two things coincide. The low on the, well, not the low, but the start of the recent move higher on the S&P was the 29th of June, same thing on the NASDAQ. But the NASDAQ has been outperforming, and it's in pretty nice looking wave 3. You know, you look at the S&P pattern and you're thinking, you know, drift higher maybe, but that looks pretty strong. So let's take a look at the DMI, and that looks pretty good. So it doesn't look like the NASDAQ is done yet. It's certainly by the DMI, not overbought at this point in time. And notice the difference. Remember what I've been talking about with the S&P, complaining about the ADX not confirming the move to the upside. Note the difference there. That move from the low of the 29th of June on the NASDAQ, look at the difference in the ADX on that move versus here on the S&P. On the S&P, it's like, whatever. On the NASDAQ, it's like, yeah, there's some juice there. So the likelihood is that we continue up, and we're trading at 260. What was the high? Yesterday was 269. And here we go again with the same thing that I talked about with Apple with the round numbers. Look where the middle of the wave 5 is, right at 300. That could happen. And that would likely coincide with the S&P moving to new highs as well. And the disparity would probably continue, meaning the NASDAQ would probably continue to outperform the S&P. As you saw that move to the upside. At this point in time, there's no reason, you know, things can change from day to day, but right now, there's nothing there showing you that we may not go all the way to 300 on the Qs. So pretty interesting. Thanks for asking. Michael asks a question on the displaced moving average. When you have a displaced moving average, because what do we have with technical indicators? Right? Technical indicators, for the most part, are lagging. That's one of the primary reasons that we look at Elliott Wave, because Elliott Wave, I think, is the best leading indicator out there. Now, we look at moving averages a lot, don't we? I mean, I'm always talking about that 10-day moving average and showing whether we're short-term overbought or oversold. So moving averages are good gauges of where things are short-term. So with a displaced moving average, and the one that's used quite often, which is the one we look at as well, is a 6-4. So basically, you're looking at a 6-day moving average, so it's even less than the 10 days, so it's very short-term. So you're looking at, you know, what's happening currently, and then it's displaced 4 days. And what that means is that they use a mathematical formula to say, if the moving average continued in the same mathematical way that it is, where would it be 4 days from now? So it's trying to give you an indication of where things are going in the future. So it's trying to make moving averages, which are by nature lagging, right? Because they're showing you what's happened. That's how they're based, on what's happened. But with the displaced moving average, it's trying to tell you if all factors stayed the same with what's been occurring, here's where it's likely going to be moving forward. So we look at it a lot for a corrective move, like, is the trend going to break? So if you can forecast where the moving average may be on a short-term basis, and then the market breaks below that, that could be an early indication of, hey, we're about to have a corrective move. Maybe we're about to start the wave 4. Maybe the wave 5 is over. So that's how it's used most often. But good question, because not a lot of people really fully understand the displaced moving average. And a lot of people don't look at it enough because it can be a help in where things are going to be moving forward. As we know, no indicator is 100% accurate, but you put all these things together, and that's what we do, is we put all our indicators together in a basket. Stock's got to follow and be a yes on several different indicators, and if it is, cool. Let's see what Elliott Wave says. That's how we do it. On the subscriptions, a question on the subscriptions. I do want to remind you, I mentioned that you would have saved an entire month's subscription just on the LOGI by timing your exit the way we did. You can subscribe month to month. We don't ask for a year up front. You don't have to sign a contract. You don't have to pay for a year in advance. We're month to month. So give it a try. One trade, you got the rest of the month is free already. So anyway, thanks for the question. Netflix. Yeah, we sent that one out. And if you're here, this is a good one. We sent this one out as an alert to our subscribers. And this is, I'm actually going to do one of our trade reviews on this because I think this is a very good lesson to the market. It's a good educational. So we had a, let's move back a few days. So we had a butterfly, and we're in the last couple of weeks before expiration, and our butterfly was 480, 500, 520. So we're right in the wheelhouse, right? The market is trading right in the wings of the butterfly. Sorry about the lines not being so perfect, but normally the best thing you can have happen in an out of the money butterfly, in other words, we put the butterfly out of the money, we're expecting the stock to continue to the upside, so we get a benefit of being right directionally, and then you wait and hope that it hits between the wings of the butterfly. It doesn't have to. If you're right directionally, you still make a profit. If it gets within the wings of the butterfly, you make more. If it gets within the wings of the butterfly within the last 2 weeks before expiration, usually that's grand slam time. That's when we've had a couple of those in the last couple of years, and that's just, you make a ton of money on those. So this one was looking like it was going to be one of those home runs. Well, we got out at 309 was the pricing, and right now it closed at 257 today, and that was with a move back to the upside. That was better because it had actually reflected a loss. We entered at $1.79, so we entered at $1.79. We sold it for 309, so that was good. But you look at this and you're thinking, well, let's just hang in there, right? We just, every day that goes by, you're going to make a whole bunch more money. But it wasn't. Why wasn't it? Because Friday's expiration, well, guess what Thursday is? It's earnings for Netflix. And guess where max pain is? Do you know what max pain is? Do you know the theory of max pain? Max pain is the strike on the front month that has the highest open interest, meaning that if the stock was to close there, the greatest amount of people would lose money. So there was some things there like, oh, wow, that's max pain. We could hang in here, and hopefully as we get closer to expiration, it stays around that 500 mark, which is dead in the middle of our butterfly, and we make a ton of money on the trade. But because earnings are on Thursday, they are not going to allow you, they being the market makers, are not going to allow you to buy a 1 day, like, on, I don't know if the earnings, let me see, are they before market or after close? After market on Thursday. So they're not going to let you on Thursday buy a 500 strike straddle. So buy a call and a put at 500 and catch a 1 day explosive move. And, Netflix tends to move on earnings, right? We know that. They're just not going to let you do that. So the way they avoid that is they make you pay a ton of money for it. So they hold the premium in. So this premium that should be eroding over time has not been. And that's why the trade at $1.79 to $3.09 is still a very nice trade, right? I mean, that's a $1.30 profit on a $1.79 risk. That's a good return. But it should have been, it could have been several 100% return with that time frame. But because the earnings were on Thursday and they held the premium, that tells you that the stock is likely going to make a pretty big move on earnings. The fact that they're holding this premium, you don't know in advance that they're going to do that. You know that they're going to hold some, because again, they're not going to let you have the 1 day straddle. So what will happen on Friday is that 500 strike is, unless there's any intrinsic value, but the extrinsic value will be gone like that. So whatever you paid on Thursday, you're probably going to lose a ton of money if you try to do a 500 strike straddle on Thursday. That's, it's you can see where people would think, oh, 1 day I can get a super cheap trade. Netflix is going to make a big move after hours on Thursday. I'll buy this straddle on Thursday, makes a big move, and I sell it on Friday on expiration day and make a 1 day trade. They're not going to let you do that. They're smarter than that. They're smarter than you are. So they're not going to let that happen. So we saw this hammer doji starting to form, and it's like, okay, in general terms, a hammer doji is forecasting a move in that direction, right? A continued or significant breakout type move in that direction. So we sent the closing alert out, 309. Look what happened the next day. How good of an exit was that? So it blew way out of the wings of the butterfly. So again, it was at a little bit of a loss at one point in time. It's back to being slightly profitable now. It's at 250. I think I said it was 250 something's where it closed today. But we sold at 309, so we still made over 50 cents more. But that's the hammer doji tells you that that's likely to happen. And you can't risk that, or there goes your profit. You have a nicely profitable trade 1 day and the profit's gone overnight, just like what happened with Logitech. So if you're still in this position, I can't give you individual investment advice. I can't tell you what to do with your trade. I can't tell you what to do with your account. As we said in the beginning, we're not licensed to do that. So I am not giving individual investment advice. But what I can say is that it would be risky to stay in a position going into earnings if the stock is likely to make a big move. And that's what they're hinting with the value of the options. They're hinting that the stock is probably going to move significantly on earnings. That's why they're holding so much premium in the at-the-money strike, the max pain strike. So I would think tomorrow would be a pretty good day to try to get out of that if you were still in it. Baba, entry question. Well, let's take a look at it. We'll just go right to the website. We'll look at it on the website. Well, we'll look at it here. So we entered this one on the 10th. So let's go to the 10th. So we're here looking at the moving averages. There's that hammer doji again. So what did it do with Netflix? It exploded to the upside. Do we have a little bit of separation here? Yeah, we do, especially for, or even for a $260 stock. It's not as pronounced because it is a higher dollar stock, but there is separation there. So it does look a bit overbought, but look at the DMI. So the two primary things was that you can't get a better looking one than that. Remember, nothing's 100%. So here, good separation between the two directional indicators. The ADX is moving to the upside, and that's as good as it gets. A little bit of overbought here, but the hammer doji, which with Netflix indicated that big, massive move to the upside. So we didn't want to miss that because we weren't that far away from where the target is. So in this case, the stock did do what happens quite often, came back to the 10-day moving average. So nothing really to worry about there, but that was the reason. Willing to accept a little bit of a move back to the downside if it came back to the 10-day moving average versus missing a potential explosion to the upside, all would happen with Netflix. So again, indicators don't do what they're designed to do 100% of the time. It did what it was supposed to on Netflix, not necessarily on this one, but good question. That was the reasoning. Very fair question. Ray asked, would I ever trade the wave 4? I trade any wave that has a pattern in it. 1, 2, 3, 4. If we're going to be talking a lot about degrees in the new Elliott Wave class, and if you have some sort of a corrective pattern, you can break it down so you trade waves within waves all the time. And any of the waves that has some sort of a corrective pattern, I'd be willing to trade, except flats. I don't like to trade flats, but if there's a triangle or a zigzag in the wave 4, trade it. Absolutely no problem doing that, and I've done it before. Good question. AMD, do a couple more here and then we'll wrap things up. AMD. Still not, we've looked at this one before, but the ADX is still not too excited about this. Probably the reason is it's in a lot of resistance right here. Still sitting at all this resistance. And until the ADX wants to confirm some of the strength, it's going to have a hard time breaking through that. I mean, it does have a target higher. The wave 4 is at a good point of support. We're above the major moving averages, so maybe it gathers itself and tries again. But the ADX and the DMI are not super supportive of breaking to those new highs at this point in time. Oh, trading wave 3 to 4? Right, yeah, I mean, the answer to the question is still the same. It doesn't matter what wave we're in to me, as long as, and we don't label, the wave 3 till we know for sure it's in a wave 3. That's the way the software works. So you can't really trade 1 and 2. When I said 1 or 2, I wouldn't, but it was just a philosophical point that I don't care what wave we're in. I'm trading the pattern. I know that a lot of people teach with Elliott Wave, let 1, 2, 3, and 4 form and trade the 5. Hopefully you've seen enough in these events that we've been doing to realize that you're missing out on an awful lot of trades if you do that. XLF, financial ETF, we're bank earnings time, very difficult time for the banks, and it's really not too excited about. We're at a 58% corrective level. It's basically we're hanging on for dear life at that last fib level. See if we can mount any sort of a charge. The ADX is like, yeah, now. See, that's not what you want to see. When you're trying to mount a move, You don't want to see the ADX going the exact opposite direction. It's a really good indicator of trend strength. So that's telling you there's no strength there. I really think if the banking sector moves up, this is just my opinion, if the banking sector moves up, it's just going to be short-lived because it'll catch maybe a little of the money rotation. I'm going to leave you with that. Sorry if I know we had a lot of questions, but we're out of time. But I did want to mention this, that when we talk about money rotation, money moves from different sectors. Now we know it's been in big tech. We know it's been in the NASDAQ. But aside from that, it's really moving quickly. It's finding stocks that have not participated from a percentage standpoint. So you kind of feel like that's the machines, which is another benefit of having software. Because if you don't have software and you're trying to analyze charts and you're trying to do it by sight, and all these other people are analyzing based on software, you're at a decided disadvantage. But when you watch the rotation, they're finding stocks that are oversold or not participating as much with the market, and then they're moving into those, but for a very short period of time, they're catching a bounce and then they get out. So my long-winded point here is that I think that could happen in the financials just because they're way underperforming what's going on in the market. But from a fundamental standpoint, you can certainly understand why that they're underperforming. But if there's a bounce, I just think it's short-lived. And I think the DMI is showing that any sort of move higher is just an oversold bounce, but watch out below. Personal opinion, again, the charts are saying possibly hang in there. Elliott Wave pattern, again, hanging by fingernails, but the DMI is not confirming anything. Remember, we need both. We need our confirming indicators and Elliott Wave to agree. That's when we enter and exit positions. So I hope you found tonight informative. I think we showed some really cool things, and hopefully it gave you some confidence based on sharing our performance. We like to say that we walk the walk and talk the talk. I mean, we're transparent. We're right there. We're right with you. And very good question on Alibaba, which, why did we enter at a slightly overbought condition when it moved down? Hopefully that explained it to you. But we're here to face the music, if you will. Thanks for your attention this week. Hope you have a wonderful week, and I look forward to talking to you again next week. Take care, everybody.